Welcome to Real Vision's Trade Ideas. Today we're sitting down with Jay Van Sciver of Hedgeye. It is great to have you back.
Great, thank you so much for having me here.
So what is your trade idea today?
Well, last time we were here, we did Rollins and Tesla as shorts, and less people think we're perma bears. We're going to talk about a long. We're going to talk about Mohawk and residential construction in general.
Okay, so this is a little bit of a contrarian bet in some ways because a lot of these building product stocks have been beaten down pretty hard over the past year. Before we get to the bull case for those stocks, could you talk to us about why this area has struggled over the past year or so?
No, I think it's a great question, right? So you had a series of really unusual and exceptional events happen to the building products and construction material space. First, you had tax reform. Tax reform, generally major house, and even the most optimistic view, less of a tax shelter. A lot fewer people are taking advantage of the tax benefits afforded to residential housing. Second, you had, in 125 years, you've never had more rain than you had in the first half of 2019, which I think is a stat that people haven't quite internalized, but it was the wettest year in the period that NOAA's measured over the last 12 months, right? So they've been doing that for a long time, since like 1895. And it's very hard to do certain construction activities in the rain, and then construction projects get delayed, things get pushed out, even interior work gets pushed out because buildings aren't finished, right? So I think it had a much more significant impact than a lot of people recognize in the first half. We see it in farms, as you see tractors stuck in the mud, but I think it's been less focused on in the construction space, in part because it's been going on for a while. We've had rain for a long time. We've had record rainfall over the last 12 months in April, record rainfall over the last 12 months in May and June, but finally it didn't rain in July, and we're seeing some of those hours for construction equipment and other metrics pick up a bit. And then the third thing is we had a spike up in interest rates in the middle of 2018, and interest rates are now down. And we tend to see, on average, construction spending respond to lower interest rates with about a 7-month lag. So we should, as we enter 2020, at least on a relative basis, have a better environment for residential construction, building product suppliers like Mohawk.
And what about things like tariffs and other factors like that?
That's a great one. I forgot that one as well. Like tariffs had the effect of creating a pre-buy in, for example, flooring, which we import from China. So ahead of tariffs going into place, distributors will tend to inventory product to get a discount ahead of these higher prices. So we see this in import data, spike in imports, and then we see it come back down as tariffs actually go into place.
So right now we're kind of in that lag area because there was sort of an over purchasing before.
Exactly. We have too much inventory from tariffs. We have too much inventory from lower than expected demand. So people are building for a certain residential construction spending growth, and you end up with less residential construction. So you end up with too much inventory, and then they have to cut production, margins go down, and that's the typical kind of cycle we go through. And we see a pretty clear path to better demand, basically following lower interest rates and easier comps.
Okay, so yes,
less rain.
Yeah, less rain. Well, so you mentioned lower mortgage rates. So the 30-year is now below 4%. It's been that way for about 2 months now. And we've seen a pickup in mortgage applications, but we haven't seen that pickup in construction and spending. And you were saying that there's about a 7-month lag or so. Where are we right now in terms of that cycle, and when do you see that coming to fruition?
So as we describe it to our clients, we think investors will end up, at least on a relative basis, chasing these names in the first quarter of 2020, when we start to see residential construction spending pick up on a year-over-year basis. The comps just get easier. The tailwind of basically, if you buy a house, it takes a while to actually plan and make renovations or whatever it is you're going to do. It isn't an instantaneous get a mortgage and suddenly the spending goes up in the same month. And interestingly, two things that happened on the Mohawk call this quarter. One is that they didn't mention weather, which I found shocking because it was an extremely unusual event. And secondly, they seemed surprised that the spending on their products wasn't coincident with lower mortgage rates. They cited like a 3-month lag, and it's longer than that. It takes a little while for it to filter through. It isn't perfectly 7 months. It's just sort of the best, R-squared that you get as you do the incredibly flawed statistics on it, but it clearly is on a lag.
And then in terms of your view on the overall economy, are you bullish on specifically construction stocks? Are you also bullish on the housing sector overall? Where does this fit into your thesis?
So I think we're in a classic industrial deceleration. So we're seeing GDP growth slow. Our macro team does a great job of laying out sort of how that echoes through the economy. And In that environment, we get a lot of what we would call like classic cyclical value traps. We have Cummins, for example, as a short idea that we had at the end of last quarter, because as you get fewer orders for trucks, you need fewer engines, you get less volume over your factory, margins compress, volumes come down, pricing is under pressure. It's sort of a, classic downturn. It's always surprising how much cyclical earnings go up. It's always surprising how much cyclical earnings can go down. And I think when we look at our long list, there are a couple of idiosyncratic names, things with some exposure to like defense, some unusual fleet dynamics, but for the most part, we don't have as many longs in the industrial sector as we have shorts. I think it's a period of time when the industrial sector and cyclicals, materials, tend to underperform on a relative basis. We call it quad 4 when we have, in this quarter, growth decelerating and inflation decelerating. We transfer next quarter what we call quad 3, where we have growth deceleration and inflation picking up. None of those environments are great for most cyclical companies.
So then how would this play for builders? I mean, would you be concerned in a slowing growth environment that building stocks might not perform so well?
So one of the things we like to think about is like, what is the long cycle doing, right? So we usually describe that to people in terms of the shipbuilding cycle, because it's a great cycle. Like after World War II, you had a ton of ships that get converted to the commercial fleet. So you have this spike in tonnage additions, but you get a 30-year cycle in that. So 30 years later, you get this big replacement cycle, and the peaks out in the late 70s. Those ships get replaced, actually peaks out in 2011. Our launch short was Samsung Heavy as a best idea short in 2012. And the reality is it doesn't matter what the economy does. Everybody bought a ship. Like the ships have been replaced. There's going to be very little demand until you should buy Chinese shipbuilders. You can mark your calendar in like 2038 or whatever it is. It'll work. Those ships will meet salt water and they will need to be replaced. And so we like those long cycle dynamics. If you get that right, it becomes very obvious that if you're long, high PE cyclicals at the beginning of a replacement cycle, it's almost certain to work. And if you're short, low PE value traps on the other side, it's almost certain to also underperform, right? What we see in construction is, from a long cycle perspective, the stock of residential housing is aging, right? We're spending below replacement demand on residential construction. We're also spending below replacement demand on non-residential construction. And probably the worst one, not to get politics involved, but is infrastructure, where we are severely underspending. We actually see the average age of streets, roads, and bridges aging exponentially. So when we look across the industrial universe, like what's the most sort of dollar value cyclically depressed market, it tends to be construction, right, across different verticals. And that gives us, if you enter a cyclical downturn, if you enter a slowdown, first for residential construction, you get the tailwind of weaker growth means lower interest rates. You tend to get lower mortgage rates, which is at the margin helpful. But you also, I think, from a longer term perspective, are entering a period where you have better demographics. Millennials are entering their early 30s, where they tend to buy first houses. We're entering a period where you have to start to deal with some of these aging of assets, right? Even if residential construction spending picked up, say, 25, 30%, you'd still be only at sort of normal levels of construction activity. You wouldn't be cyclically inflated. You'd finally maybe have your assets stop aging as quickly as they've been aging. So that kind of already being below cyclical norms provides a bit of a buffer into any kind of broader economic slowdown.
Gotcha. So then could you talk about the stocks that you're looking at in this space?
So we look at Mohawk, and I think one thing that's interesting about cyclicals is what we call the narrative, or the story that gets built up around them, right? So in the case of Mohawk, there is a structural problem where there's this stuff called luxury vinyl tile, which sounds like an oxymoron in a product name. Like, how could vinyl tile be a luxury? But it has taken a lot of share, and Mohawk doesn't have as much capacity to produce it. And the reality is that that's happening, and that's basically a capacity adjustment that Mohawk will have to make over time. That is sort of an issue, I think, that gets blown out of proportion. That becomes like the fixation for investors when the stock is down 60%. It already is down as much, roughly, as it went down in the financial crisis. Like, it's down. Investors clearly think whatever's going on is structural. So in the case of Cummins, electric vehicles could become that on the short side. So these narratives get out of control and create these sort of exceptional value opportunities. And I think that's what's happened at Mohawk, right? I think it's pretty cheap here. I think it's positioned for a cyclical rebound. It rained, and people think it's LVT. Is basically the problem with the narratives.
Looking at Mohawk, that stock dropped pretty dramatically in the past few weeks after it released earnings. And the CEO said that there were concerns over volume and pricing. Is that something that resonates with you? Is that something that you're a little bit hesitant about with the stock? Or are you see upside from here no matter what?
Well, I think one of the problems with cyclicals is you have to buy when the CEO is telling you things aren't great, right? You don't want to buy a cyclical when margins are at, this isn't, the Google in 2002. It's not going to have, a huge endless market. Housing is like a, GDP plus or minus business. It's not going to get, as people would say way back when, trees don't grow to the sky, right? It's going to be a contained story. So you generally want to buy cyclicals when there's something wrong. You're always getting something with a bit of hair on it, or when, it feels bad. Usually the earnings are down, the multiple is high, and it doesn't seem like it makes a lot of sense, and that's when you kind of have to buy, right? Like when you see the inflection. And I think mortgage rates give us some visibility to an inflection in residential rates. I think it would be kind of shocking, if you really step back and think about it, if the CEO of a building products company coming out of the rainiest first half in 125 years, which impacts construction activity, didn't find that they had too much inventory, that they were planning for a 125-year record rainfall, the wettest, period that basically NOAA's measured. That would be a surprise. That would probably mean that they were underproducing for what would be a normal environment. So the fact that we're coming out of sort of tax reform, tariffs, and this sort of record rain, it would be surprising if, in fact, they didn't have too much inventory in the channel, that there wasn't pressure on pricing, that they didn't feel like they need to reduce production to match demand. It would be amazing.
How much potential upside do you see in a stock like Mohawk?
Yeah, I think that's always an interesting question in a cyclical, and I think that they can be seem remarkably expensive when they're down and remarkably cheap when they're up. And it really looks that way as a person who looks at cyclicals all the time. Like, that's my job for decades, right? They actually look, expensive because they tend to be, when they're down, earnings are decelerating. They look problematic, right? But for that as a framework, I think, Mohawk probably earns more than $10, right? And it's probably a better than average growth, earnings growth name as we enter a recovery in housing activity. So I think something like 200 is a perfectly reasonable expectation, and it's at whatever it is, 114, 115. Mm-hmm. So I think it offers a good deal of upside with a pretty straightforward catalyst in recovering residential construction spending from lower interest rates.
And would you enter at current levels? Would you say now is the time?
We have it as the best ideas long. Mm-hmm. So yeah, we did a deck putting this thesis out last Friday. Mm-hmm. So we're doing a deck on a Friday in August. We feel good about the thesis, which may be, and it's totally wrong. Like, we can be certainly wrong, but we say what we think, and I think that's a name where I have a pretty clear visibility to at least a better environment for them.
In terms of backing out of the stock, if you are wrong, is there a certain level that you'd be looking at, or a certain narrative that would have to shift for you to step away?
Yeah, I mean, there are, I guess, if you saw, real new problems with construction in some way, interest rates, inflation, things that we don't necessarily see could become problems. I think there are concerns around LVT that I guess if they played out differently would be a problem. I think one of the, as a problem with that story of imports is that things at that weight and price don't generally get imported, right? Because they're heavy. And once we get domestic capacity in place, we'll see fewer imports. But if we had some problem with domestic capacity ramping up, that could be an issue where, in fact, we're going to be stuck on importing flooring. Mm-hmm. That would be a potential issue. But I think, the problem with longs in general is that they are more boring, right? Like, I think residential construction gets a little better, and the stock does pretty well because it's down a lot, It's already down as much as roughly it went down in the financial crisis. So I think the asymmetric setup, and flooring companies attract terrible puns on valuation, like the floor is in or whatever. Yeah. Flooring secured was the joke we made, but playing on Elon Musk. But the reality is that it's already down roughly as much as it went down in the global financial crisis, which is also known as the housing crisis, right? Like, it's probably a reasonably valued name here And I think that sets up an asymmetry.
Great. Jay, thank you so much for joining us.
Thank you very much.
So Jay's bullish on building material stocks. Specifically, he likes buying Mohawk Industries, ticker symbol MHK, at current levels with upside potential of $200 over the next 12 months. Just remember, this is a trade idea and not investment advice. Make sure to do your own research, consider your risk tolerance, and invest accordingly. For Real Vision, I'm Justine Underhill.